Hey there, Lafayette. Grant here with the Tax Shop Lafayette, and today we're talking credits and deductions. I'll tell you which is better for you to have, and also how to make sure you don't miss out on these and end up paying more money as a result in taxes. Okay, so you've probably heard the phrases tax deduction and tax credit thrown around. A tax deduction is simply a reduction in your taxable income. Now what that means is it reduces the amount of your income that is subject to being taxed. There are a lot of different types of tax deductions, ranging from deductions for charitable giving, to education, to even contributing to retirement accounts. Now a tax credit actually takes the amount of taxes you owe and reduces it in a dollar for dollar fashion. For example, if you owe $100 in taxes but have a $40 tax credit, now you only owe $60 in taxes because it reduced it in a dollar for dollar fashion. There's also a lot of different types of tax credits available, including tax credits for having kids and tax credits for going to college. Let's take a look at a quick example to determine which one is more valuable for you to have as a taxpayer. Let's take a look and see how a deduction would work. Let's say, for example, that you have $10,000 in income and a tax rate of 10%. Now with $10,000 in income and a tax rate of 10%, you would pay $1,000 in taxes. That's 10,000 times 10%, $1,000 in taxes. But now let's say that we found a deduction. You have that same $10,000 in income, but we found a $4,000 deduction, which is going to reduce the amount of income subject to being taxed to just $6,000. Now we take that $6,000 times your 10% tax rate, and you only pay $600 in taxes. Now compare that to $1,000 in taxes, and that's a win. But now let's take a look at tax credits. Let's say, for example, you had that same $10,000 in income, that same 10% tax rate, and so you would pay that $1,000 in taxes. But instead of finding a $4,000 deduction, we actually found a $4,000 credit. Now the credit works by taking the amount of taxes you owe, $1,000, and subtracting dollar for dollar the amount. So $1,000 in taxes minus the $4,000 credit, and that's a negative number, negative $3,000. What that means is that's $3,000 that's going to be refunded back to you if it's a refundable credit back into your pocket. So as you can see, both deductions and credits are wins, but the credit is a bigger win because it works in a fashion dollar for dollar. But here's the catch. If you overlook a credit or deduction that you qualify for, you're going to end up paying more money to the IRS than you really need to. And here's the kicker. They aren't going to tell you. They're just going to keep all that extra money that you paid them. I understand some people may feel it easier to use at-home tax software, but you do risk leaving money on the table if you overlook a credit or deduction that you qualify for. So that's why we're here. I encourage you to give us a call and let us help you get every dollar you deserve back into your pocket this tax season.